And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner, Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well. Take a little bit of time for yourself, and I just want to say a warm welcome to you to today's program. Today, we're discussing the question, is it time to begin to fear FOMO? Now, if FOMO is a new terminology to you, it probably shouldn't be, but it is for some. FOMO is obviously an acronym, and it means the fear of missing out, FOMO. And I want you to just take a moment. I want you to just think about what's been going on in the market today. Think about what's been going on in the market really over the course of the last, say, 6 months. And it is an unbelievable transformation. Now, today in the stock market compared to where the stock market started and what it looked like and what it was doing in really the first 4 to 5 months of this year, it is a completely, totally different animal. It seems as though it's going absolutely to the moon. And let me ask you, when you look at the market, when you look at everything that's going on, does any of that concern you at all? It seems like the butcher, the baker, the candlestick maker, everybody's getting on the bandwagon. And is that a signal to you and I that we need to get off that bandwagon? It's a legitimate question. It's a question that I think we should be asking ourselves. Now, granted, there's probably two different types of listeners that are on this radio show and watching these videos. The first is going to be the person who's kind of naturally always been inclined to be on the more conservative end of the spectrum. And maybe you really don't trust the stock market. You really don't have much of a desire to be in it because you know how volatile it is. You know how risky it is. And you're just not that type. And you know what? To know thyself is a very important winning attribute when you're an investor. But then today, I want to be discussing and maybe talking, having a conversation with those of you that are on the other end of that spectrum. The individual that has been, you know what, pedal to the metal. Let's be on this bandwagon. Let's follow this herd. Let's pour all the coals into making as much as we possibly can and kind of throwing caution to the wind. Now, here's the thing. If you're young, if you're still very much in the accumulation stage of your life, I have absolutely no problem with that. In fact, I encourage it because let's face it, you're not going to be retiring for quite a long time. However, just last week, I ran into a lady who is in her mid-70s that is still working full-time. And why is she still working full-time? Because she simply doesn't have the savings. She ended up making some bad financial decisions. It ended up costing her a tremendous amount of money. And as a result, she can't stop working. She just simply does not have the Social Security to be able to maintain her lifestyle, as simple as that lifestyle is. And so when you're in the distribution stage of your life, you're at the most vulnerable stage of life that you possibly can be in. And if you win big, well, that's great. But if you lose big, it can mean the end of retirement for you. It can mean you doing what this lady is doing and having to go back to work. Now, before we get into answering this question, is it time to fear the FOMO? I encourage you, if you're brand new to the program, number one, welcome again. I hope you stick around. I hope you become a fan and a listener of this radio show. I hope you learn a thing or two. But I also encourage you, utilize all of the resources that we have available. Many of them are free. And they're available at our website, johnsonwim.com, where you can watch past YouTube videos. You can also listen to past radio shows. You also have access to educational white papers, things that will help elevate your level of learning about what it really takes to be retired successfully in today's world. Today's world is obviously very different than what it was just 30 or 40 years ago. But I also encourage you, if maybe you're the tangible type, you can go to any major book retailer and you can find my book, a copy of my book, The Capitalized Retirement, affordably priced and written in such a way to help convey real life educational facts and ideas and strategies that you can employ. You don't need an engineering degree to read this. It's something that's simple, something that will make sense to you to help you see how you can take everything that you've worked so hard to save and to accumulate and turn it into an income stream that's going to protect your lifestyle. And isn't that what it's all about? Being able to maintain our lifestyle and do the things that we want to do in retirement without having to worry? That's my idea of a capitalized retirement. Now, let's get into this. So we really want to just ask the question, have you been watching what's been going on in the market? Year to date, the Dow Jones is up 12%, which is fantastic. Looking at the S&P 500, year to date, it's up 17%. Year to date, looking at the NASDAQ, it's up nearly 23%. Those are fantastic numbers. And it seems like every single day, the market is logging new record highs. And the big question for you is, number one, what's going on? And I would say the next big question is there going to come a time where enough is enough? Is there going to come a time in which the market decides that it's done reaching new highs and now it needs a breather? Are you prepared for that? Have you decided what you're going to do in the midst of potential panic? Because in the same way that the baker, the butcher, and the candlestick maker have all seemingly dogpiled into the stock market, we have retail investors that are continuing to plow more and more money into the stock market and drive it to new highs almost every single day based on optimism, not fundamentals, but optimism. What are you going to do when that bubble begins to break? Have you thought about it? Now, as an advisor, as a fiduciary, my job is not to be a Debbie Downer. My job is not to try to poo-poo any part of the market. My job, in fact, is actually to work with you, for you, in such a way that is a benefit to you. And if things are going well in a particular area, we need to be in it. We need to be functionally in it and making money and taking advantage of the opportunities that abound. But as an advisor who's quite well seasoned, nearly 3 decades in this industry, working with literally thousands of individuals over the course of my time in the market, my time working with clients who have money in the market, I can assure you that there's one thing that very little technology or time or shall we say ingenuity has addressed within stock mutual funds, within stocks, within trading platforms. And that is, what do you do when the human element strikes? What do you do when all of a sudden we wake up one day as if we're the country of Holland and we realize how stupid it is that we've been spending so much money on tulip bulbs? Now, it's been a long time since I made any reference to tulip mania. But I will assure you, if you want a good read, if you want to read how just unrealistic the human mind can carry a person's behavior, I encourage you, do a little bit of homework. Google that insightful time in history in which we are seeing what optimism, exuberance can do to a country, to human beings, Tulip Mania. It's fascinating. It should be mandatory reading for young people in school. It should be something that you and I, as retail investors, should be paying attention to, keeping ourselves and our emotions in check. Because here's the thing. When we think about valuations today, in other words, the prices that we are paying for stocks versus reality, I'm sorry, folks, but things just don't math out. While technology and innovation is very real, and those things are impressive, and they're currently taking and driving stocks higher and higher to the moon, anything technological seems to be affected by this black hole of optimism. The reality is that we can look at what's called the CAPE, the CAPE. That's basically the cyclically adjusted price to earnings ratio. And when we look at these companies today, we're staring at levels that have only been previously seen just before the dot-com bubble and just before the Great Depression of 1929. I want you to just think about that for just a moment. You see, we're seeing kind of a divergence that's taking place within our market right now. I've already mentioned the retail investor, the you and the I, the Joe Sixpack, the small person who seems to be very optimistic and willing to invest their money into anything that looks tech related because, well, the atmosphere is to get your money invested. At the same time that we look at the other side, which is the retail investors, the big institutional money, and what we're seeing is that while the institutional money and institutional investors are being extremely cautious, and there's an awful lot of caution that they are vocalizing, saying things are getting a little too top-heavy, things are getting a little too overheated, a little frothy. Well, guess what? The dumb money, as they would call it, your money, my money, is still flowing into the market on a daily basis. I want you to think about that for just a moment. When we come back from our break, we're going to be discussing what prudent investors should be doing right now in order to defensively keep the winnings that you already have on your end of the table. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? If you're just joining us, welcome to today's program. Today, we're asking a very weighty question. Is it time to start fearing FOMO? The fear of missing out is a very real thing. You've experienced it. I've experienced it. It's just a part of being a human being. But as we watch and we are looking at what's been unfolding in front of our very eyes with regards to the market, with the market hitting new highs every single day, I want to ask, is this not potentially some cause for concern? Are we not seeing our fellow man, maybe even our own selves, taking and putting money into the market in areas that we have no business being in, spending money, spending beaucoup dollars to buy a share of a single stock and way overpaying for it because we have no sense of understanding whether or not it truly is a good price or not. You see, oftentimes this is the reason why so many investors rely upon financial advisors and fiduciaries to help them stay away from emotional decisions, to help them potentially have more prudence and more fundamental data to justify a particular purchase or a particular sale. But you know what? Even financial advisors can be, well, they can be victimized by all of the environment all around us. In the beginning of the program, I discussed the three major indexes that you and I hear about almost on a daily basis. We heard about the Dow Jones that's up 12%, the S&P that's up 17%, the NASDAQ that's up nearly 23%. Well, let me just ask you a question. Going back kind of in time just a little bit, we discussed in a previous radio show something called price to earnings ratios. And I'm going to bring this up again because if you're not familiar with price to earnings ratios, they really are. They can be an extremely helpful way to be able to quantify something that's absolutely huge that can boggle our mind and make it simple enough that we can understand it. So let me just give you an example. Let's say that you wanted to buy a small business. Let's make it an ice cream parlor. And that small business, you do your due diligence. You walk in, you talk to the owner, you say, hey, if I was to buy this business from you, I first need to know how much you actually net for profit. Would you mind sharing that with me? And of course, this business owner is happy to share that with you. And he says, absolutely, I make $100,000 net profit every single year. And you say, great. Here's my deal. I'd like to offer you $3 million for your business. Now, number one, do you think he'll take that? I think he would. I think if you were the business owner and I was offering you $3 million, you would laugh all the way to the bank. You would tell me, press hard, sign, there is 3 copies, right? I would probably do the same if you offered me that for my business. But the reality is that despite the fact that we all know that that's absolutely bonkers, we know that you're going to be scooping ice cream for 30 years before you even have your money paid back to you. Well, guess what? People are doing that and so much worse when it comes to stocks. We've all heard of a company called NVIDIA. Did you know that right now investors are essentially spending $54.50 for $1 of earning? That's crazy. That's the same as you spending $5.4 million on that ice cream parlor. When we look at a company like Tesla, we've all known that Tesla, since the very beginning, has been an extremely volatile company. And there's been good times and there's bad times. And when there's great times, or when there's good times, it's like there's great times. And when there's bad times, there's just absolutely horrible times. It's extremely volatile. But today, right now, as things stand, the price to earnings ratio on Tesla is over 300. Not 30, my friends. 300. And yet retail investors are pouring money into the stock. Now I want you to just hear me for a moment. This could be one of 2 reasons. The first reason is that they truly do have conviction that there will be future growth of, we'll just say Tesla for right now. We'll use Tesla as an example. Their cutting edge technology for artificial intelligence, their market share within the automotive world, the software and the internet and all the various parts of this company that are expanding and that are developing. They're looking at the stock and they're saying, in the future, I believe that this company will have quadruple or better their earnings that they have today. So I want to buy the stock today because I believe it's cheap compared to what it will be in the future. I'm going to buy it now. I'm going to overpay knowing that that company will only grow into those earnings. Now, is that you? Are you doing that? Are you really drilling down on the numbers, looking at the numbers of these companies that you're buying? Are you questioning your financial advisor as to why he's buying what he's buying? What's the second reason? I said that there was 2. The second reason that people fundamentally are buying what they're buying is out of pure, and I hate to even say it, but I'm going to because it needs to be said, pure ignorance. Retail investors today are pouring money into the stock market. Institutional investors, it doesn't make it right, but it is what it is. Institutional investors are looking at the amount of money that is absolutely pouring into the stock market right now from retail investors, and they call it dumb money. And the reason being is because, well, let's just face it, institutional investors, institutional warehouses, these institutions have been through the ringer. They've been the ups, the downs. They've seen the expansions. They've seen the contractions. They've seen the growth. They've seen the loss. And they're looking at this, knowing that this potentially could be a massive bubble that is similar to that of 1996 to 2000, the precursor to the dot-com bubble. And so I want to ask, is it potentially possible that you have forgotten, that you've strayed from the word diversification? Because, folks, my friends, it's not just a slogan. Diversification is real. Diversification is making certain that not all of your eggs are in one basket, making certain that you're not investing simply just in different names of stock, but rather investment classes. They have a financial advisor with a level head and with a calm demeanor and with logic and fundamentals, and can look at your stage of life, what your real need is, and give you advice that is in your best interest. And here's the thing about advice. It may not be the advice you want to hear. It may not be the advice that you want or that you expect from the financial advisor. Now, with that being said, bubbles can run a long time. And I certainly don't want to be a Debbie Downer. I don't want you to walk away with the impression that the market's not going to continue to go up and then it's going to just bust tomorrow. Because you don't know that and I don't know that. But what we do want to do is we want to make certain that if we have a portion of our money in the growth, especially in the Mag 7, in the tech area, that we're just not continuing to pile money upon money. We're not continually pouring money into things that fundamentally the math just doesn't make sense. We're overpaying. We're paying $40,000 per acre of farm ground when we know that the outcome, the future growth, is not going to be worth it. We want to be looking for maybe potentially all of the good value things. The things that haven't been inflated, maybe the things that are more ho-hum, maybe the things that are producing a dividend of 4 and 4.5 and 5%. And though they are boring, though they are maybe kind of like watching paint dry, maybe these are the things that we should be loading up on. Because we know that at some point, just like with Holland, just like with Tulip Mania, when all of a sudden everyone wakes up and we smell the roses and we realize just how foolish we have been, we realize just how foolhardy it was to be a part of the herd and to continue to chase this train up a mountain just in order to catch it in time to ride it back down. That there could be things we could be doing to safeguard our principal. Things that we could be doing today. And if you're retired, this is even more crucial for you. Even more important. Even more, well, shall we say, plausible. Because here's the thing. Growth stock, growth companies, growth products rarely pay you what you need the most when you're in the distribution stage of your life. And if you already beat me to it, and you know that the answer is income, well, my friends, that's exactly what we need to be focusing on. Income that is real income, Not imagined income, not income where we're having to liquidate and sell our own principal and then pretend in our brain that it's income when we know darn well it's not. Or either getting rid of a stock or we're getting rid of the capital gain of the stock. I'm talking about real income, interest and dividend income that you can spend every single month knowing that it has absolutely zero to do with your principal. Your principal is still growing. It is still compounding. It's getting bigger as the market allows. And even if things decline and things pull back, and we all know that the market is, well, shall we say, maybe getting long in the tooth and overdue for a bit of a pullback. Well, you never want to be running out of income. You want that principal to be invested in such a way that is creating the interest and the dividend for you, whether things are going extremely well, like they are now, or things are bad, like they could be in the future. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.